Good afternoon, everyone. Welcome to this presentation on analyzing cyber incidents from a risk assessment perspective. And our goal here is to try and understand, in terms of assessment and managing risk, that then will result in greater resilience of cybersecurity hazards in the private sector. Of course, this is all very well-known information to most of you. Cybersecurity is very closely tied to the health of our economy. In fact, the World Economic Forum estimates that by 2020, we may have as much as $3 trillion in losses due to various cybersecurity incidents, a big number. And cybersecurity also is about national security. And we think of things like hospitals and police departments and how they've been targeted with ransomware that basically involves a lot of our very vital and private information. Our work here is focused on the private sector. And for looking at incentives to improve cybersecurity in the private sector through market-oriented solutions, that is, harnessing the power of markets and incentives. What we basically urge is that proper risk assessment and risk management can improve the resilience of companies by guarding against cyber risk. So in order to sort of have a better ability to assess risk, we first begin by putting together an extensive database on cyber incidents. We've compiled data from all publicly available sources and private sources that we could get access to data from. We use the data provided by Advisen, a very large provider of cyber loss data and other data for casualty and property insurance. We've also looked at public databases like the BCDB and WHID, and we've put together an extensive repository. The Advisen database is very comprehensive. It also gets actively updated, and there's a lot of complete information relating to cyber incidents. I just provide a small little summary of the kind of data that's available for each cyber incident. I'm not going to go through all of them. Suffice to say that each cyber incident is coded on a variety of fronts for a variety of variables, everything from the progression of events related to that cyber incident to specific characteristics of the parties that are involved, the outcomes, some information related to the victims, and very detailed information about the incident from various kinds of news media. We then combine this cyber incident repository with financial data on the victims. So we put together a unique database combining the cyber incident data with CompuStat data, which is a leading source of corporate finance information that is used by finance professors and so on all across the United States. And so then we have literally 1,000+ companies, most of them publicly traded, where we can match all of the financial data together with the cyber incident data. And we're unaware of any studies that have sort of put all these fundamentals of the victim companies and cyber incidents together and explore the relationship between the two in the manner that we do. It then allows us to ask a whole bunch of research questions, not all of which I'm going to be able to do justice to in this talk, but it allows us to ask questions like, what kind of corporate financial factors affect the frequency of cyber incidents? Does it matter how a particular company is positioned at the time of a cyber incident? What exactly is the impact of these cyber incidents on companies in terms of losses, reputation, etc.? And what exactly are these various types of impact? So stepping back a little bit, based on all the information we have, we see that these cyber incidents, based on the causes of these incidents are split into 15 different categories, everything from cyber extortion to various kinds of malicious breaches to phishing, privacy, skimming, so on. So there's like a whole bunch of causes that typically are coded in these cyber incident databases. And we can see that that makes for a pretty unwieldy proposition in just a minute. In addition, we can also see from the data that we've put together that there is a rapid increase in the number of incidents each year. The number of incidents has in fact grown to almost 25%, by 25% each year. And the number of affected companies has gone up also by about 22 plus percent. And what has happened here is that the incidents per company has also increased. And so essentially the number of incidents that each company is experiencing each year has gone up. And it's now, as we shall see, up to about 2+ every year in the entire database on an average. Now the cyber incidents, of course, nowadays has a whole bunch of components. They arise from vulnerabilities due to the actual IT infrastructure, whether it's a network or in the cloud. It of course involves people who may be responding to certain phishing emails, so on and so forth. But it also involves other kinds of operations within a company involving data collection and disclosures and so on. In addition, we also see that hacking techniques have improved. One example of what I saw, which was sort of pretty far-fetched, but still kind of amazing, if you think that there are Israeli researchers who believe that they could steal data from air-gapped computers using the sound that was emitted by the cooling fans. I mean, undoubtedly, even a company like Microsoft, you'd think they would certainly have the ability to do a good job with their cybersecurity, but you can see that there is a significant increase in the number of cyber incidents. And in fact, certain categories like phishing have increased a lot. And that's, of course, the dark blue purple spot that you can see. That's increased a lot. At the same time, the amount of malicious data breaches has pretty much stayed constant for over a multi-year period. And so we can see that there's not only an increase in the number of incidents, but the types of incidents are much more diversified. So these incidents, from a risk perspective, they result in what is sometimes called first-party losses, which mean that these are losses by the victim. And it also results in so-called third-party losses. In other words, other people and other entities that are affected. So for example, if you have something like, say, Target be the subject of a data breach, and if your financial information is compromised, then the banks that gave you those credit cards are also going to be affected because they have to then cover those losses. So those are sort of third parties. And in addition, of course, some people and so on who are affected are also sometimes involved in third-party losses. So from the database involving 40,000 plus cyber incidents that we have put together, we see that about a third of those incidents result in no loss. But the other 2/3, there is a typical median loss of somewhere around 1 million. And we can see that the average loss is about 270,000. And you can also see that there is a significant tail where some of these cyber losses associated with a small number of incidents can reach even $1 billion. This is a logarithmic scale, by the way. So if those of you are sort of wondering what's going on, I'm talking in terms of millions and billions, and these numbers are 1 and 2 and 5. It's because it's a logarithmic scale. In addition, again, this is also, the y-axis is a logarithmic scale here. It plots the frequency of various types of losses in the x-axis versus the dollar amounts in the y-axis. And you can see that the mean loss is somewhere slightly less than $1 million, but you can see that for things like financial damages, which is the very first category, there is a large number of these incidents that results in financial damages. Financial damages may be ransomware, or it may be money that is transferred inadvertently through a phishing attack, etc. There's a large number of them, and you can also see that they are widely distributed. They're long tails, and so it presents a problem from an insurance perspective, that you have some losses that are well beyond $1 billion, et cetera, that somebody may have to bear. But then you have other types of losses that may be frequent, but the distribution of them is pretty tight. So, for example, property damage to the first party, it's significant, but actually it's a pretty tight distribution. So you don't have a wide variance, and so you're able to predict the losses more clearly. And there are certain others that are quite small. We can see that things like fines and penalties are also a category where there's a large number of them, but fines and penalties are also widely varying, in part because the fines and penalties are often related to the financial damages. So from a cyber insurance industry perspective, several years ago in the early 2000s, I had written a paper that the cyber insurance was a very effective way to deal with this risk issue. And to basically, it's a very effective way of spreading the risk throughout society and also creating incentives for parties to adopt cybersecurity measures, because the insurance industry is capable of doing things like incentivizing you to improve the overall level of security, kind of like rewarding good drivers. And so the market is still in its infancy. In the United States, the penetration in terms of the number of insured companies is relatively low, less than 15%. But nevertheless, the market is growing fast as we improve our ability to understand this market. And the market is actually growing annually by about 30% in the last few years, and we have almost $2 billion of premiums in 2015. So the coverage itself involves basic coverage that you might imagine for things like liability associated with network security, et cetera, but it also includes other things like business interruption, with consequences because your systems have gone down. And it also includes other coverage like computer forensic costs, hiring experts, et cetera, to figure out how deep and how widespread is the attack, and also for providing notification to customers, sending letters out to people, so on and so forth. Nevertheless, there are some typical exclusions that you find as well in these policies. So where we are today is in this market, to really allow this market to grow, is on several fronts. First, we have a problem that we don't have good data. And that's one thing we're trying to address. The data scarcity problem, we're trying to address that. The second thing we're trying to address is distinguishing between people who present varying levels of risk based on understanding their risk posed by their facilities. So we really have to sort of improve our risk assessment. And currently, because of the inability to understand and separate out risk, we have sort of adverse selection and moral hazard problems, which is sort of illustrated in this little flow chart. So you say, well, you've got an informational asymmetry. You don't really know what is the risk posed by these people. You are the insurance company, and there's an insured company on the other side. Because you have this informational asymmetry, you tend to be cautious and say, hey, I will charge a higher premium. I will charge 1 to 3% of the total amount of coverage that you are seeking every year. That's roughly the rates where we are today. When the premiums are so high, for example, if you want $1 million of coverage, you have to pay $10,000 to $30,000 every year. When you have to pay that kind of high premiums, then what ends up happening is you get fewer buyers. You get fewer buyers because people say, hey, I can sort of, I can do better than this, I can do this myself, etc. But then the people who buy the insurance ends up being the people who really feel that it is still a good option for them. In other words, their risk is so high. So you're dealing with now a classic market for lemons, George Akerlof's famous work, where basically you're dealing with people who present high risk. And these people then, as a result, you have poor data. You have poor data because you're now dealing with a pool that is primarily risky. You also then, as a result, the insurance companies respond by saying, okay, then I'm going to exclude all these high risk situations. I'm going to exclude them, and I'm going to cap the coverage, right? So in other words, you have this problem of high premiums, exclusions, and policy caps, all of which are designed to basically protect the possible losses, but it doesn't help in expanding the insurance market. So in order to sort of understand the space better, we've tried to sort of do more work in trying to meaningfully categorize these various types of losses, understanding them, and we also try to sort of model portfolios of companies. So let's try and understand a little bit more about cyber incidents so that we can have a better sense of how to group them and pool them together. Cyber incidents, of course, have many attributes. They have many actors who have various motivations that results in various types of losses that are caused by various kinds of vulnerabilities, etc. And then the end result is a certain set of affected assets. Now, which of these things are really important from a cyber insurance perspective? So in order to understand how this works, you have, let's say, a cyber incident that occurs. Based on the type of incidents, in other words, based on the type of peril, is this a DDoS attack, is this a phishing attack, is this something else, it may or may not be covered by your policy. So that is basically the first threshold. So for example, if it ends up being a situation where you have some criminal activity, there may be an exclusion for criminal activity in your insurance policy, so it may not be covered. If it is covered, then it may result in various kinds of losses. Then you ask the second question, if the peril is covered, are the losses the kinds of losses that is also covered? So for example, it may cover losses to your inventory, losses to your hardware, but it may, for example, not cover subsequent losses like business interruption losses. Well, those may not be covered, for example. Or perhaps certain types of losses going above a certain limit are not covered. So then you then ask yourself, are these losses covered? Some of them may be covered, some of them may not be covered, and then you decide. So essentially it's a two-tier inquiry. And there's two stages that you have to go through. One is related to whether the peril is covered, another is whether if the peril is covered, then are the losses covered. And these are sort of defined in insurance policies, and we assume that for our purposes that there is no ambiguity in them. Of course, I want to make sure that in fact, this assumption allows us to actually be very conservative in our estimates because we end up sort of over calculating what losses, etc., we may have to deal with. So we're being very conservative in our approach. In addition, we're doing other work that I want to flag, where we look at policies that are litigated in the courts. And we've put an extensive repository together where we deal with things like ambiguity in insurance policies. So we deal with that question in another space. And so then we ask ourselves, how do we pull these incidents together that have different causes and different types of losses? And how can we sort of pool them together meaningfully? So here we have all the various types of causes on the left-hand side, and on top in the columns, we have the various types of losses. And you can see that the first column is financial damages. This is direct financial damages. This is actually money that is involved. And you can see that almost all of them, they do result in money damages. But certain categories like identity fraud and cyber extortion and physical tampering or skimming result in very significant amount of money losses. Other categories, the money losses are not as substantial. So given the fact that we have so many different causes, what we have tried to do is we've tried to optimize between abstraction and partition. And we've tried to sort of optimize. In other words, if you finally divide the data too granularly, then you basically can, of course, explain everything, but then you're not able to do accurate analysis because you have very small number of incidents in each category. At the same time, you don't want to abstract away too much and lose information. So that's kind of what we tried to do here, where we try to distinguish between incidents that pass both filters if they result in similar insurance claims. And if they don't result in similar insurance claims, then we put them in a different category. So having done that, what I've shown here is this results from this incident type clustering, where we use this k-means clustering method, and we group together incident types rather than incidents themselves. And using the elbow method, we basically calculate that with 6 categories, we can explain 91% of the variation in our data. So we can sort of collapse those 15 categories that we see in all the data for all the various types into actually 6 categories. And we can explain more than 90% of the variation in the data. And beyond 6, we reach a point of diminishing returns. So it makes no sense to add more clusters because you're explaining very little of the data. And so here are the 6 categories that we've come up with. And the 6 categories actually, even intuitively, if you look at them, they make sense. So you're dealing with privacy violations, you're dealing with sort of various kinds of disruptions to the network and to your cyber services, industrial controls, these are all industrial control systems, OT, operating technology, that's in a separate category by itself, dealing with all kinds of cyber extortion and fraud that relates to sort of identity, phishing, skimming, all that stuff goes in one category. Malicious data breaches goes in another category, and unintentional data disclosure goes in another category. So you can see that the losses associated with all of these are sufficiently similar that it makes sense to lump them in these 6 categories. That then, we now dealing with a much more manageable problem in terms of the types of losses and the types of causes. Okay? Moving on. We then also do something called resampling to try and model portfolios. So we estimate the cyber incident rate in a group of companies. And we can then look at the number of possible claims that arise from, say, a portfolio of insured companies. We're making some assumptions that basically allow us to model the worst case scenario, because we say every incident that occurs will result in a claim. And we also assume that all the claims are covered. So you can see we're being very conservative. And of course, for our purpose of our analysis, we don't assume the portfolios are changing in a big way year to year. So then what we did was we got a list of publicly traded companies in the US, and we obtained a lot of information on these publicly traded companies. And there's about 5,700 of them. And the exchanges we considered were the NASDAQ, NYSE, Amex. And we also tried to lump some of the companies together where we're dealing with different classes of stock or divisions from the same company, so that we ended up with a meaningful number of about 5,700 companies, starting with about 6,600 companies. Then what we did was, now that we have these large number of companies, we randomly sampled 1,000 companies from this list to form a portfolio. So we basically assume that each company has the same likelihood of purchasing cyber insurance, and then we repeated that process 1,000 times. So essentially, we've created 1,000 portfolios, each portfolio containing 1,000 companies. All right? So we have a massive amount of portfolios through statistical resampling. The advantage with statistical resampling is that it doesn't make assumptions like this is a Gaussian distribution or a normal distribution. It doesn't make any of these kinds of parametric assumptions. It simply takes the distribution in your data and preserves that distribution. So then we go and look up those companies and from these portfolios and see how many cyber incidents they had in each year. And then we record that cyber incident for each portfolio. And so then we have essentially, remember, we have 1,000 portfolios, each containing 1,000 companies for each year. And now then we have a pretty good idea of the portfolio risk. And so here are the results from our analysis. It's a little bit hard to follow, so let me try to be as clear as possible. The y-axis asks, out of these 1,000 portfolios, how many of these portfolios had a cyber incident associated with it? So you can see, and by the way, this graph here is cumulative between 2011 and 2014, so you can see that the average at the top is about 300 out of 1,000 portfolios had some cyber incidents associated with it. The x-axis says in each portfolio what percentage of that portfolio has had a cyber incident associated with it. And so that's in percentages. So typically about 2.5% to 3% of the portfolio, each portfolio of 1,000 companies is affected. So in order to understand this better, I've instead of overlapping one above the other in a cumulative fashion, I've plotted the 4 distributions for the 4 years between 2011 and 2014. And you can see that the blue distribution is moving to the right with the passage of time. So what is happening is the means of and that is the percentage of cyber incidents each year is increasing, right? So the entire curve is shifting to the right. And so we are now seeing, in more recent years, we're seeing that the means are about 3%, when previously they were only about 2%. And in addition, some of the frequencies are also going up. And so here's the raw data. And so in the raw data, you can see that the means in terms of the cyber incidents in each portfolio is going up and is almost reaching 3%. The maximum is also increased quite a bit. So as much as close to 4.5% of the entire portfolio might actually experience some cyber incidents. And our confidence level is pretty high. In addition, you can see that as a result, in more recent years, the spread in the data is significant because the standard deviations are going up. Okay, so we're trying to improve risk assessment by trying to understand cyber losses, by trying to understand distributions of cyber losses, by trying to meaningfully categorize these cyber losses, and by trying to sort of look at what portfolios might look like so that we can essentially get our arms around the problem of what is the total exposure, right? So in the process, we're also looking at more harder to get at things like business reputation. Okay? If you talk to everybody, people generally believe that these cyber incidents have a negative impact on a company's reputation. If you talk to corporate managers, as Experian did with the Ponemon Institute, senior managers say data breach can really do some damage. In another poll, you talk to consumers, on the other hand, And consumers say, we're not going to do any business with people who have suffered a data breach because we're worried. Okay? Well, so that may be so, but nevertheless, there is very little empirical evidence and scholarly evidence to support what some of these polls are showing, that consumer loyalty is in fact going to be affected by a data breach. So we decided to, okay, well, let's take a solid, hard look at this and try to understand. And we're in the process of doing it, but I wanted to share some results that we're seeing with you. Once again, combining the cyber incident, cyber loss information together with the technological causes, together with the financial data, allows us to sort of look at things like changes in stock price on an everyday basis as a function of time, and look at things like prices before and after a cyber incident with different windows. It allows us to sort of look at changes, say, within a month on either side, 2 months on either side, 6 months on either side, so on and so forth. And those are the kinds of things that we can do. So once again, I don't want to spend a lot of time telling you how we collected the data. Suffice to say that we can do some very careful event studies and try and keep track of the data. So in addition, reputation. Well, how do you measure reputation? That's something that is sort of very nebulous. So once again, we have used the measures for goodwill that is used by the regulatory agencies like the SEC, and we try to estimate goodwill from the financial statements. Of course, we can use other alternative indicators like earnings quality or market-to-book ratio. In addition, we're able to, because we have so much data from so many companies, we're able to do things like study a company in a sector and then look at how the earnings have been affected in other companies in the same sector, so that we can essentially extract out or control for effects all across a particular market segment or across a particular sector. In other words, sort of like for those of you who are sort of statistically minded, it allows you to do things like a difference in difference regression, where you have control groups and treatment groups, and then you can sort of look at how this entity that's the treatment group gets treated relative to the control group. So here's an example of, Target experienced this big data breach, you guys might remember, right before Christmas in 2013. And we began by just looking at consumer interest as measured in the number of times that searches involving Target showed up in various Google searches. So initially, right after the incident, there was a big spike in people looking for information about Target, and then it's sort of the interest died down roughly about a month later. The incident itself took place on the 19th of December. And here we have the stock price, and this is sort of the day of the cyber breach. And by the way, the red lines are down days, green lines are up days. This is just simply the variations in the stock. And we can see that, roughly speaking, a couple of weeks before the disclosure of the cyber incidents and a couple of weeks afterwards, you can sort of see that even if there was some, perhaps significant dip in the stock prices, there really was not a big difference if you look at it just simply a few weeks before compared to a few weeks after. Now, if you look at the same thing in terms of earnings, and these are earnings, both revenues and net income, both. Now, this is, of course, the holiday period, and this is, of course, what the hackers were targeting just 6 days before Christmas. And we see that the sales income and the net income of Target did go up. We don't exactly know what is the effect of the cyber breach, because we would really have to compare it to other companies in that space, and we're trying to do that. But suffice to say that by the time the third quarter of 2014 rolled around, income and sales were roughly at the same level as they were in the third quarter of 2013. So in other words, a year before to a year after. So this is the kind of stuff that we're looking at carefully to try and understand if some of these things are just simply impacts over a short period of time, or is there really an impact on longer timescales? So that's the kind of stuff that we hope to get a much deeper understanding of, especially since there is a lot of debate about whether companies do take a big reputation hit or not. And if they do take a hit, then we try and understand what sorts of measures are better than others to mitigate the impact on reputation. So I want to sort of quickly summarize, and then I'm happy to take questions. Cyber insurance can be a very effective way of spreading cyber risk throughout society, and at the same time, insurance can incentivize us to invest in cybersecurity as a whole by passing on some benefits. In other words, if you do things like invest in improving your security, then we will give you a break with reduced premiums, so on and so forth. But unfortunately, we're at a point where risk assessment and risk management is not that great, and so we currently have very ineffective pricing and sometimes flat prices for over 50% of the market. And so we really need to have the ability to distinguish between people that pose various risks. And we're really trying to get at the problem of data scarcity. But of course, we realize that that may be a harder problem to solve in the very short term. Over a period of time, of course, we will learn more. So what we're doing is we're putting together this data and trying to understand what we can learn from cyber incidents, and we're trying to improve portfolio risk assessment. We're trying to understand cyber losses. We're trying to sort of utilize the incident data we have more efficiently. And there's other work that we're doing as well, and this portfolio analysis of risk work complements other work that we're doing in our team that focuses on technological risk, where we have tools that can go and assess the vulnerabilities in your hardware and software by scanning through your infrastructure and then coming up with a score based on the vulnerabilities associated with those hardware and software, looking at the National Vulnerability Database. So by looking at the National Vulnerability Database, we can now estimate what is your technological risk. Now, once we know your technological risk, we can combine it with the financial risk data that we have to see whether this company presents a greater or lesser risk compared to, say, other companies in its own sector. Like, for example, you may be in a sector where you have a lot of cyber incidents. So in which case, even a lower level of cybersecurity might be very hazardous. Or you might be in an industry where, in fact, there are very few attacks, so you can afford to be a little lax. In addition, what are the losses associated with those cyber incidents? So we combine the technological assessment with the financial assessment. And then we also have another cyber insurance litigation analytics database where we are putting together all the cases involving cyber incidents that are litigated in the courts all the way to a decision. And there we can see what kinds of losses are being covered and what kinds of losses are being frowned upon, and so that we can improve the actual instruments. We can improve the actual policy instruments so that we can have more clarity and bright line rules in that area. So our portfolio analysis of risk work is combined with our technological risk and legal risk. And so ultimately, improving our overall ability to assess and manage risk. And I'll stop right here. Of course, none of this was done by me. I have a wonderful team, and I'm very, very grateful to them, and I'm happy to take questions.
I would assume that there would be sanctions should a company not report a data breach and should they be found out. Now, I'm wondering, are there any studies or any data on not reporting, say, recent case of Experian or Office of Personnel Management or Target, if they don't report it, maybe it never happened. And there's also cases, are there any fail-safes? And then also, in some cases, they'll discover a data breach that has been ongoing for, say, 18 months. They've been doing it all along, and now we just find out about it. So are there any statistics, or as far as someone not reporting it and now the public feels confident they're not dealing with a company that ever had a data breach because they never self-reported they had one?
Excellent question. It's also a question with multiple parts, so let me try to sort of unpack it. First, yes, there are clear regulations by agencies like HHS, the SEC, and in different sectors of the economy that basically say you must do certain things to keep your infrastructure secure. So in other words, if you are an entity that is offering healthcare services, you are required to have certain types of cybersecurity measures, et cetera. And if you don't, and if you fall below that sort of reasonable care that a prudent entity would engage in, then there are fines, so on and so forth. And there are situations where the fines can be quite extensive, which is one of the reasons why in our data, fines and penalties is an area where, in fact, there is significant exposure. So yes, there are regulations in place. We can argue about whether they're sufficiently well done, or if they're at a sufficiently high standard, so on and so forth. So we can certainly argue about that. Secondly, the notification of breach issues. So every state, pretty much, it's something like 47, there's just a couple who don't, have data breach laws that require you to do things like notify people and notify them in a reasonably prompt manner. Now, some states have laws that are very onerous. In other words, they actually require you to inform customers and inform them in a very short period of time from when the breach was discovered. Okay? There are other states that do things like, you only have to notify the Attorney General. You don't even have to notify the customers. You don't even have to notify the victims. You just notify the Secretary of State or the state's Attorney General. And they say, inform everyone in a reasonable fashion. Now, what is reasonable? 20 days, 30 days, 80 days, whatever. Now, having said that, a lot of times, the real problem is not so much, I'm not saying it's not a problem. I mean, the notification is still an issue. But a lot of times the bigger issue is discovering that, in fact, you have been hacked. So the only companies, the joke is, that hasn't been hacked are the ones who don't know that they've been hacked. Okay? So part of the problem here is being vigilant and having the mechanisms put in place to discover the hacks promptly. So I think we're getting better at that piece. So does that make sense?
Yes. Also, is there any...
you're going to have to use the...
Is there any data on, how plausible is it that a company would just choose to ignore the law, not report, in the hopes of profit, and not worried about basically getting caught and facing any sanctions?
So the question is, are the regulatory mechanisms well designed to ensure that companies are engaging in an optimal level of self-auditing? That's really what you're asking. And we can certainly debate that. Now, as far as data goes, every incident that results in a lawsuit being filed, that we're capable of tracking. But if there is, even before the lawsuit is filed, if there is some settlement or consent decree or something else that gets worked out between the regulatory agency and the company, then we don't have access to that in the sense that we haven't tracked it. We would have to go to each agency site and look up all those consent decrees and do that, and we haven't done that. But yes, the data, some of those more esoteric data is out there. But you ask a very good question, which is, how do we know that basically the regulatory agencies are engaging in an optimal amount of self-auditing in terms of creating incentives to engage in self-auditing, creating incentives for companies to report promptly, and setting up the right kind of regimes to do those things? Great question.
We do have an online question. Someone asked if there's a detailed write-up of the methodology that you used.
We are in the process of getting papers published, and so some of the papers do contain detailed descriptions. All of the work done in my group can be found on ssrn.com, ssrn.com. By the way, this is the largest open repository of scholarly works, and so in all over the world. And so typically faculty from business school, law schools, finance, accounting, marketing, all these sorts of programs, all our work can be found on SSRN, the Social Science Research Network.
First, I have a point and then a question. And my point is that if you are back to where you were within a few months ago after a breach, even if it can be shown that there was a considerable negligence in terms of good digital hygiene, and for example, thinking of the case of Target, it appears to me that market solutions will not solve this problem. This may be because Target and Home Depot, the other case you cited, are so dominant in their respective sectors that people will just do it. And for me as a consumer, my bank tells me, well, you got to get a new credit card. Was it caught up at Target? Well, we can't tell you. But yeah. So, they cover my loss, but somebody's absorbing the loss, and it's not Target. Now, the question I had, of course, I imagine you put this presentation together before Equifax, but that data and IT infrastructure is ultimately in the case of, or in support of a business model. And I'm wondering if we're just allowing companies to engage in increasingly risky business models, because the credit reporting agencies started out as reporting credit. You've got bad loans, you've got a good payment history and that kind of thing, and this is to assess creditworthiness. But they have become data brokers, and Equifax is a perfect example. Let's package this data and, in a variety of ways and give it so that people like me get unsolicited credit offers, which, by the way, maybe somebody can steal out of my mailbox, which in itself is a risk. So I think that, and we're in a very counter-regulatory time politically, but really maybe it's time to apply the brakes. It's not just that Equifax exercised bad digital hygiene, which is almost certainly true, but that their business model made something like this almost inevitable. And I'm sorry. And I turned it off for the meeting and I thought we were done. It makes something like this inevitable, and at the end of the day, I sign no agreement with them, and I get no benefit from what they do.
Right. So first, at the outset, we're interested in having a more secure environment for our data and our computing infrastructure. That does not mean, first, that the only solutions are market solutions. Completely agree with you. Your point, for example, that we may need better regulation, etc., is a very good one. And it may be that credit reporting companies might be a sector of the economy where we might mandate certain things. So maybe similarly, we might do something for things like our personal health information, or we might do something for utilities. So there may be critical sectors of our economy that we might decide to regulate, and we might insist that they affirmatively have a duty to keep our data secure, right? Currently, we don't have it is, for example, you have a duty to exhibit reasonable care when you do certain things. We don't have an overall legal duty to keep all data secure. There is no such duty. Okay? So we might decide that for certain sectors of the population, of the economy, where they have a lot of information about large sectors of our population, very critical data, 140 plus million people, so on and so forth, we might decide that, hey, it is time to mandate certain types of protections. And by the way, that would be welcomed by people like those who are offering private solutions and insurance companies, et cetera, because it increases the overall protections in society and reduces the losses that have to be covered. So you can see that there are complementary approaches that would work well together. So it's not, this is an environment where it's not either or, but it's more that you may need better regulations, but you may also need better market solutions as well. Okay. Does that make sense?
Yeah. Just as another aside, recently, in the last few days, I read, I believe it was in the Washington Post, that credit reporting in many countries is actually a public function.
Right. Right.
And that, maybe Equifax is, and this is not the first time, but this is the most egregious breach. Maybe they should just be out of business.
Right. And keep in mind here that some of these things, like as the average citizen's understanding of the exposure, et cetera, increases, we may see a response as well. Because, a lot of it depends on the appreciation of the impact of these things by, the average American.
I have two online questions, and I'm going to start with the second question first, because this actually kind of is similar to what Al was just asking. This person asked, there was a report that some Equifax executives sold stock right before the breach was disclosed. While they said they had no knowledge, do you think this will cause changes in international reporting requirements for companies?
So that is the alleged insider trading piece, which is when did they know what they knew and did they act on some inside knowledge? And that's something we're just going to have to find out, and we're going to have to, I'm sure that the various prosecutorial authorities are looking into it, but that is a separate piece. That's a separate piece. It may be an indication of, things like what was the environment in a particular organization, so on and so forth, but that's simply trading on insider information that, will be the subject of prosecution, I'm sure, if after an investigation it is deemed that charges can be brought.
The second question is a follow-up to the methodology question. This person asks, what explicit model validation and verification has been conducted?
So we are very much in the process of trying to do some of the validations. And in part, for example, things like the loss information. The loss information is reported by the victims. So we are relying on things like the victims basically reliably reporting their losses. We have reason to believe that they would do so. But we also have reason to believe that in some circumstances, they may not do so. So sometimes it is well known in the insurance industry that victims very often overestimate their losses. So for example, when you have things like coverage for a house, very often victims will post the losses based on the value of whatever they had when they bought it, without taking into account that they enjoyed these things for 20 years. So you have overestimation. and so that's a type of moral hazard. But you also have situations where victims may underestimate because they're worried about reputational losses, et cetera. So validation is a good question, and we're in the process of doing more work on that score.
Hi. Kind of going off of the second question and what you had said earlier, and like how Equifax kind of took...
Speak up, please.
Yeah. Going off the second question and what you said earlier about how it kind of takes companies longer to notify the public because they simply don't know about the breach, would you say like that's the main reason they take so long to get to the public, or what would you think?
Well, there are basically two things, right? One is, have you put mechanisms in place so that you increase the likelihood of detecting breaches promptly? So that's the first question. And so the question is, are they doing that? Right? So you want to have a regulatory environment where companies are incentivized to do that. Right? So, in other words, to do the kind of monitoring on a routine basis, using digital forensics and other tools to try to basically be prompt at detecting. That's one issue. The second issue is, after it's detected, are you going to promptly put remedial actions in place, including notifying people who may be affected promptly? And that's the second piece. Right? And so we would want to do both. We would want to create the right kind of regimes and the right kinds of rules to incentivize people to engage in self-auditing, and which would then result in presumably prompt self-detection. And we would also want them to engage in prompt remediation. Some of the data notification rules in the states does the second, which is, hey, tell people promptly. But this first piece of improving self-auditing to achieve early detection is, I think, a piece that really does need to get worked on, where there is not as much work. So that piece is so in other words, we don't want people to be playing ostrich. And they want to be sort of creating mechanisms for people to discover breaches. Okay. Well, great. Thank you very much, and thank you all for coming. And by the way, if anyone has any other questions online or live, feel free to write to me at Illinois. It's just Kesan@illinois.edu. So I look forward to your questions and comments.